Do you want to spend $10,000, $20,000, or even $30,000 per month? In this video, I'm going to show you what kind of income you actually need to earn if you're self-employed to support that kind of lifestyle, especially here in California. I'm Matt Ryan, certified financial planner and founder of Focus Mission Financial, where I work with successful self-employed professionals and business owners who are earning great money, but trying to figure out how to make the most of it and keep more of it in their pockets. With that, let's dive into this case study where I'll show you what you need to make in order to spend $10,000, $20,000, and even $30,000 per month. But before we get into how much income you need to support $10,000, $20,000, or even $30,000 worth of monthly spending, let's set the stage with our hypothetical clients here. We have John and Marissa Pelican and their son Augusta. I met John playing golf at Pelican Hill. Super nice guy, terrible golfer. Anyways, John and his wife Marissa are 40 years old with an 8-year-old son. John is self-employed, he's a golf tee salesman, hasn't done any kind of tax planning whatsoever, so he is just straight up a sole proprietor. Marissa, for this example, is currently not working. Another important note as we look at this case study is that they are assumed to live in San Diego, which means they are going to be subject to California income taxes. Now, Marissa and John are wanting to do some planning and have just reviewed their expenses. The next step is to figure out some income targets for John, since he's very much a goal-oriented person. They want to know how much he needs to make so that they can spend $10,000, $20,000, or even $30,000 a month. Let's look at their first scenario. In this first scenario, John and Marissa want to spend $10,000 per month, which includes their mortgage, groceries, their kids' sports, John's golf, and all the other normal living expenses. They also have the goal of saving 15% of their income, which matches up perfectly with the general rule of thumb here in the financial world. I'll touch more on this rule of thumb when we cover the $20,000 and $30,000 spending scenarios, because it's such an important point and has a very big impact on what John will need to make. So let's see what income it takes for them to spend $10,000 per month. This is the planning software that I use with clients, and over here on the left is their income. It shows John's income of $215,000 in 2025, which is all from his one source of being self-employed selling golf tees. Then we look at their expenses. This number looks larger than the $10,000 per month or $120,000 per year because this number includes the taxes that they're going to owe on John's income. Remember, he hasn't done any tax planning, he hasn't looked at setting up an S-Corp or any of those other fancy things, so he is paying quite a bit in taxes. So setting that point aside, he is also contributing $23,500 to his solo 401k for the year, which will give him a tax deduction because that money is going in pre-tax. That's really the only tax help that the Pelican family is getting in these scenarios. The next column we'll look at is the net cash flow column. This number is what they would end up with in their checking account at the end of the year. It is what is left over after all the expenses, taxes, and retirement plan contributions. If we take this number, add it to the $23,500 that John put into his solo 401k, we get pretty close to that 15% savings target they have. This means it would take roughly $215,000 of income for John and Marissa to comfortably afford spending $10,000 per month and hit their savings goals. Now that we know that, the next question is how much do they have to make to spend $20,000 per month? And the question you might be asking is this: wouldn't you just double the income since they're doubling the expenses? And while this is a great train of thought, unfortunately the answer is no, for several reasons. Let's take a look and I'll explain. Here's the scenario where John and Marissa are spending $20,000 per month. Immediately, when I look at this scenario, my eyes go to the $500,000 of income required to spend $20,000 per month. Now, there are two primary reasons for this and why we didn't just double the $215,000 of income that we used in the first scenario. One is about taxes, and the other is about my recommendation once you get to these higher income levels. So first off, all this extra income that John is receiving is being taxed at his highest tax bracket. Remember, the IRS in California have a progressive tax structure, meaning as your income goes up and the more you move up into these higher tax brackets, those dollars that are in the new tax brackets are taxed at higher rates. All this means is that John ends up paying more taxes on the next $215,000 than he did on the first $215,000 of income that he earned. This results in John needing to make more money in order to double his spending. The second reason that this income number is much higher than just doubling the first scenario's income of $215,000 is because it's my opinion that you need to save a higher percentage of your income when you're in higher and higher tax brackets. When I work with clients, anytime someone starts to get over $300,000 to $500,000 of income, the 15% savings rule of thumb should be increased to 20% or even higher if possible. There are many reasons why I believe the savings rate needs to be increased, but in short, here are 3 key reasons why. Number 1, I have very rarely seen the case, if you are making $300,000 to $500,000 as a self-employed person, that your income is not subject to big ups or downs, or you don't have cash flow challenges from time to time. So saving more when times are good allows you to save less and reduce a ton of stress when times aren't so good. Number 2 is if your expenses are increasing, you likely need to build your emergency reserves. And by saving a higher percentage, that allows you to build up those reserves quicker. Number 3, and this is the last point I'll make here, most of the time, at least with the clients I work with who are self-employed, they want to build up cash or liquidity for another business opportunity, investing in real estate, or some other large expense out there where having more saved up makes sense. Okay, back to John and Marissa's example here. With $500,000 of income, we would expect that they are saving close to $100,000 per year, which is that 20% of their income. When we look back at their scenario, he is bringing in that $500,000. His expenses are $20,000 per month or $240,000 per year, and then he has quite a bit of tax, which makes up the difference in this column. Then John is saving the $23,500 to his 401k, and at the end of the year has about $75,000 left over in their checking account to put towards their savings and investments. This gets them roughly to that 20% savings rate if we combine the 401k contributions together with what is left over in their checking account at the end of the year. So John needs to make about $500,000 a year to spend $20,000 per month or $240,000 per year. The key takeaway here, when we compare the $20,000 monthly spending scenario with the $10,000 monthly spending scenario, is that when you start spending more, you start needing more income per extra dollar of spending. This is because taxes are getting higher and your savings goals are getting higher as well. Now let's take a look at how this plays out if John and Marissa want to spend $30,000 per month. If we pull up this scenario, they now need roughly $1 million of self-employment income to support $30,000 of monthly spending or $360,000 of annual spending. Why is that? Well, if we're looking at their expense column, they are now spending hundreds and hundreds of thousands of dollars in tax. Again, in this example, John and Marissa have done 0 tax planning, so I'm very confident we could reduce their tax bill at least by a little bit. Regardless, he is still only doing $23,500 to his solo 401k, and they are left over with $200,000 in their checking account at the end of the year to save or invest. What does this mean? If John and Marissa want to spend $30,000 per month in sunny San Diego, John needs to sell a lot of golf tees and earn about $1 million a year. Now, there are many things that we didn't cover here that could reduce John's taxes. To throw out a few considerations very broadly, he hasn't looked into an S-Corp, making employer contributions to his solo 401k, backdoor Roth IRA contributions, maybe adding Marissa to payroll, and a million other things. But the bottom line here is that, yes, this is a hypothetical example created to give you some rough goalposts of what your income might need to be if you want to spend or are spending $10,000, $20,000, or $30,000 each month if you're self-employed. If you want help figuring out what your income needs to be to support the life that you want, reach out. I'd love to help you run the numbers. I offer a free 30-minute initial strategy call to figure out if I might be able to help. Appreciate you for watching to the end. If you haven't already, please be sure to subscribe to the channel for more self-employed financial content like this.